What if I told you that after age 70 and a half, you can send up to $111,000 straight from your IRA to charity every year, satisfy your required minimum distribution, and never pay a cent in federal tax on it? Not a deduction, an exclusion from income. Your bank or broker may never mention it because it's not a product they sell, but it's right there in the tax code, and it could save you thousands in Medicare premiums, Social Security taxes, and keep you in a lower bracket. It's called a Qualified Charitable Distribution. If you're over 70 and a half with an IRA, it's the tax tool most retirees never discover. Not because it's hidden, but because banks don't profit from telling you. And one simple move can shift thousands from the IRS to a charity you choose. Let me show you exactly how it works. If you have a traditional IRA, the government has waited decades for its cut. The minute you turn 73, they come knocking. It's called a required minimum distribution. The IRS forces you to withdraw a percentage of your balance every year, whether you need the money or not, and every dollar is taxed as ordinary income. For someone with $1 million in an IRA, that first RMD alone could be over $36,000. Toss it on top of Social Security, maybe a pension, and suddenly you are in a higher tax bracket. Medicare premiums spike, and up to 85% of your Social Security becomes taxable. The very tools you saved for become a liability. Now, here's what your bank won't tell you. There's a line in the tax code, Section 408D8, that says you can send that RMD straight to a charity instead of to yourself, and the IRS excludes it from income entirely. It's called a Qualified Charitable Distribution. Since the Secure Act 2.0, you can start as early as age 70 and a half, and in 2026, you can direct up to $111,000 per year from your IRA to a working charity. No, this isn't a loophole for the ultra-rich with private foundations. It's available to anyone with an IRA, but here's the catch. The rules are so narrow that one misstep, one check made out to you instead of the charity, and the entire tax break vanishes. But if you get it right, the savings go far beyond income tax. This is where it gets quiet. The IRS doesn't advertise it. Your broker may earn fees on taxable withdrawals, not on money that leaves the account. So no one mentions it. And that silence is costing retirees thousands every single year. Here's how that silence works against you. Meet Thomas. He's 73, retired, and his church has been the center of his life for 40 years. This year, his required minimum distribution is $4,000. He wants to give it all to the church. If he takes the money himself first, he pays federal income tax on that $4,000 before writing a check. Then he claims a charitable deduction, but only if he itemizes. 88% of retirees now take the standard deduction. So for Thomas, that deduction is worth exactly zero. He loses hundreds of dollars in tax, and the church receives less than he wanted. But if Thomas instructs his IRA custodian to send the $4,000 directly to the church, the distribution never touches his tax return. It's excluded from income entirely. The church gets the full amount, and Thomas's taxable income stays flat. That alone is powerful. But the real money isn't just the income tax avoided on the gift itself. It's everything that tax number touches next. When you add an RMD to your income, you don't just pay the marginal rate. You may push your adjusted gross income above the thresholds that trigger IRMA, the income-related monthly adjustment amount for Medicare. In 2026, if your modified adjusted gross income crosses $106,000 as a single filer, your Medicare Part B premium jumps by over $1,000 a year. Cross $138,000, and the surcharge more than doubles. And these cliffs are sharp. $1 over, and you pay for the entire higher bracket. Then there's Social Security. Up to 85% of your benefits become taxable once your combined income crosses $44,000 for a married couple. Take a $40,000 RMD on top of Social Security and pension income, and suddenly every extra dollar withdrawn makes more of your Social Security taxable. The QCD stops that chain before it starts, because the distribution never enters your adjusted gross income. It dissolves from the IRS's radar the moment it leaves your IRA. Let's put real numbers on it. A tax study mapped a $35,000 charitable gift from a retiree in the 22% federal bracket with a 6% state tax and RMA exposure. If he withdraws $35,000, pays $7,700 in federal tax, $2,100 in state tax, and then donates what's left, he's out nearly 10 grand in taxes. But if he sends the $35,000 directly to charity as a QCD, he avoids the income tax entirely, lowers his AGI, and potentially saves over $9,000 compared to the donation-first approach. That's not a deduction that trims a little off a bill. That's real cash that would otherwise be lost forever. And yet, most retirees never hear about it. Not because their financial institutions are breaking the law, but because QCDs aren't a product. A taxable withdrawal reinvested in a managed account generates fees. Money that leaves directly for a charity leaves the system. Nobody has an incentive to point out the door marked tax-free. But in every powerful tool, the fine print hides traps. The QCD requires an unbroken chain. Funds must pass directly from the IRA trustee to the qualified charity. One check made payable to you, even if you forward it to the charity within days, and the entire transaction is void. Now you're holding a fully taxable distribution with no do-over. Next, I'll show you exactly how to structure the transfer so it stands up, the charities that qualify, and the paperwork you must keep, because one missing letter from the charity can undo everything. Let's walk through the sequence so you get it right the first time. Start by calling your IRA custodian. Tell them you want to make a qualified charitable distribution. Those words are important. Say qualified charitable distribution, not withdrawal. Request a check made payable directly to the charity. The check must go straight from the trustee to the charity by mail. If it comes to you first, even made out to the charity but mailed to your house, some custodians still code it as a distribution to you. The IRS will treat it as taxable. No do-overs. You can use any traditional IRA, inherited IRA, simple IRA, or SEP IRA, but not a 401k, not a 403b, not any workplace plan. If your money sits inside a company retirement account, roll it into an IRA first. Then the QCD door opens. Now, where can you send it? To any IRS-qualified 501c3 public charity. Churches, food banks, universities, disaster relief, they all work. But here's the trap. Donor-advised funds and private foundations do not qualify. Even though they're charities on paper, the tax code explicitly blocks them. A lot of wealthy retirees give through donor-advised funds. If you direct a QCD there, it's void. The donation becomes fully taxable, and you lose the entire tax advantage. The dollar limit, $111,000 per person in 2026, indexed for inflation. If you're married, each spouse can give up to that amount from their own IRA. That's $222,000 you can shift from taxable income to charity in a single year. But here's the fine detail a lot of people miss. A QCD only satisfies your required minimum distribution up to the amount of your RMD. If your RMD this year is $10,000 and you QCD $15,000, the extra $5,000 is still tax-free, but it doesn't count toward next year's RMD. Each year stands alone. Now the paperwork. Your custodian issues Form 1099-R at year-end showing the total distribution from your IRA. That number doesn't automatically exclude the QCD. It shows the full amount. You, or your tax preparer, must manually enter the QCD amount on your tax return to exclude it from taxable income. If your preparer just copies the gross number from the form, you'll pay tax on money the IRS meant to be free. I've seen this happen. The charity must send you a written acknowledgement. It has to include the date, the amount, and a statement that you received no goods or services in return. No acknowledgement, no protection. The IRS demands it, and they check. The deadline is absolute, December 31st. No extensions, not even a grace period into January. You need time for the custodian to cut the check, mail it, and the charity to process it. Start no later than early December. And if your custodian says they're backed up, push. A QCD initiated on December 30th that lands at the charity on January 2nd fails for that tax year. You'd be stuck with a taxable distribution and no charitable exclusion. But we're not done with the hidden opportunities. In 2023, the Secure Act 2.0 unlocked a brand new option. Once in your lifetime, you can use a QCD to fund a split interest entity, a charitable remainder, trust, or a charitable gift annuity up to $54,000. This lets you satisfy your RMD, get an immediate tax exclusion, receive an income stream for life, and leave the remainder to charity. Almost nobody talks about this because it's new, and it's complex enough that brokers don't casually mention it. Even many advisors haven't run a case with it yet. Get all this right, and the QCD not only slashes your current tax bill, it reshapes your entire retirement income picture. But get the details wrong, and you could lose the exclusion entirely. So next, I'll give you the exact phone script to use with your IRA custodian, the words to put on the paperwork, and how to mark your tax returns so every dollar is accounted for. And I'll show you a simple pre-check you can do right now to see if your favorite charity qualifies before you ever pick up the phone. When you call your IRA custodian, here's exactly what to say. I want to process a qualified charitable distribution. Please issue a check from my IRA made payable to the full legal name of the charity and mail it directly to the charity's address. Do not send the check to me. Then you confirm the charity's mailing address and you ask for a confirmation number. That's it. The custodian may push back or suggest an easier withdrawal. Repeat the phrase qualified charitable distribution. They are legally required to process it. The paperwork you keep matters. The charity must send you an acknowledgement letter before you file your return. The letter must state the date of the gift, the amount, and that you received no goods or services in return. No value exchanged, not even a gala dinner ticket, or the entire gift fails. Check the letter when it arrives. If it's missing that line, ask them to rewrite it. The IRS can come back years later. Now, your tax return. When you file, your IRA custodian sends Form 1099-R with the total distribution amount. Your taxable amount on that line will show the full amount. On your Form 1040, you write the total distribution on line 4A. Then the taxable amount, which is the total minus your QCD, on line 4B. You also write QCD next to line 4B. That tells the IRS you excluded that portion. If your tax professional has never done a QCD before, insist they check IRS Publication 590B for the exact instructions. Don't let them guess. Now, the pre-check. Want to know if your charity qualifies before you even call the custodian? Go to the IRS Tax Exempt Organization search tool online. Type in the charity's name. If they're listed as a 501c3 public charity, they're eligible. Churches, seminaries, hospitals, food banks, they're almost all in. Donor-advised funds and private foundations are not. That tool confirms in seconds. And here's something you may not have considered. This strategy doesn't just help you, it helps the charity you love. They get the full IRA dollars instantly, with no tax drag, no gift tax return required, no deduction limitations. One retired couple in the Midwest has been using QCDs for 10 years to support their local homeless shelter. They've given over $180,000 directly, and every dollar has stayed out of their taxable income. They avoided IRMA surcharges every single year. The bank never mentioned it. They learned it from a newsletter. There's one final detail that astounds most people. The IRS projects that QCDs will remove over $700 billion from taxable retirement accounts over the next decade. Yet only about 5% of eligible IRA holders use them. The mechanism is sitting there, written into law, costing you nothing but a phone call and a stamp. So the question isn't whether you can afford to give. The question is whether you can afford to keep paying tax on money you were going to donate anyway, when the tax code gives you a clear, entirely legal off-ramp. That's the QCD. Use it before December 31st, and the savings belong to you. Don't, and you'll write a check to the Treasury that you never needed to send. The QCD exists because the tax code recognizes a simple truth. Money you give away shouldn't be taxed as income. But the reason it remains so obscure isn't conspiracy. It's incentives. Your custodian earns nothing on a check written to a food bank. Your tax preparer may have never seen one processed. So the knowledge sits in IRS publications, not in your quarterly statement. And every year, billions of dollars in RMDs get withdrawn, taxed, and then donated when they never needed to be taxed at all. So next time someone mentions your required minimum distribution, ask yourself, is this advice building walls around your money, or is it building a bridge? The tax-free path exists, and you just learned how to walk it. But knowing is step one. The phone call, the paperwork, the December deadline, that's step two. If what I just shared made sense to you, tap like and subscribe so you don't miss the next deep dive. And if you are the kind of person who wants to take action right now, check the first pinned comment below. I've put a link there with a special offer I've only made available to my viewers. Something I know will help you lock this in. Now you know the tax-free way to satisfy your RMD. The rest is up to you.